Good morning, everyone, and thank you for joining us. My name is Steve Jones, and I'm a brokerage director here at BGA Insurance. I want to thank you for joining us today. Now, this is going to be the first in the series of life insurance based sales webinars we're going to be conducting. My associate director of annuities, Trent Zimmerman, has been conducting annuities webinars on Tuesdays, but we're going to focus more on life insurance today and some sales ideas related to life insurance. First of all, a little bit of information about myself. I've been in the insurance industry for over 25 years. I've worked on both the insurance company side and also the general agency side. So, for the lack of a better term, I've sat on both sides of the table. I've held regional group manager positions for a few group insurance companies, managing multiple state territories. And for the last 10 years, I've been on the general agency side, focusing on individual products. BGA Insurance, we're a full service brokerage general agency. We're headquartered in Costa Mesa, California, but we do work with brokers all throughout the country. We specialize in life insurance, both term and permanent, also annuities, fixed index annuities, and also MIGAs. We do write long-term care insurance, and really on the long-term care side, it's been more of the hybrid or the linked benefit products the last number of years. And we don't talk about this a lot, but or enough, I should say, is disability insurance. This includes individual disability insurance, business overhead insurance, disability buyout coverage, and also key person disability insurance coverage. We represent over 60 of the leading life insurance companies. Some of these companies have been in business for more than 100 years, so they've seen a lot of changes throughout the years, and they're still around to meet their obligations to their policyholders. We do have excellent working relationships with our top carriers. We're able to get on a phone call with an executive, get on a phone call with an underwriter if we need to in order to get a decision made. We're also fortunate to have a number of our carriers have their regional salespeople in our local area. They're in our office quite often, providing us with sales ideas, market updates, and also product ideas. And they're also able to jump on the phone call with us with our agents, or maybe a Zoom meeting like we're having today. And I've even invited them to join. I got a couple new agencies I'm working with. They do in-house or in-agency training sessions, which is very important. And last but definitely not least is we're fortunate to have in-house experienced and knowledgeable case managers. They make everything go. We lean on them on a daily basis. They help us and help our brokers get applications submitted, help them get submitted correctly. If anything needs to be ordered, whether it's a telephone interview or a paramedic exam, they're going to help coordinate that. They're going to work with underwriters all throughout the process. They keep our brokers updated on a regular basis on the status, with the goal of hopefully getting the policy approved for your client, get the policy issued, and also get you paid. Now, on a daily basis, I talk to and work with all types of financial professionals. You could have independent brokers, could be a property and casualty broker, financial advisors, group producers, Medicare specialists. It is all across the board. But what I find though is the brokers that are writing the most business are the ones that are talking about the need for life insurance protections with their clients. They're asking the right questions, they're getting the right information, providing us the information we need in order to customize the quote to best fit their needs. And one of the questions I get probably asked most often by my brokers is, Steve, I'm just not talking to my clients about the need for life insurance. I don't feel comfortable. I don't know the right questions to ask. I don't know the right information to obtain. And this kind of leads into the first in our series of sales-based webinars. It is the three buckets of money. Now, some of you might have heard of this concept. The three buckets are: you have tax deferred, and those are funded with pre-tax dollars. You have taxable, which are funded with after-tax dollars. And then last but not least, you have tax advantage, which are funded with after-tax dollars as well. Now, this concept has been around for a while. Don't know exactly how long. It might even extend back to when federal income taxes were first instituted back in 1913. But it's a widely used concept. One of the beautiful things about it, it's easy to understand, easy to explain, and it's a very powerful tool that you can communicate with your clients, and with the hopes of helping you and them develop a strategy, minimize taxes, build long-term wealth, and also how life insurance can help supplement those three buckets. And what I'm going to do is I'm going to review each of the buckets, and I'm going to talk about some advantages of the buckets and then some of the drawbacks of the buckets. And then I'm going to close with how life insurance can complement all of those. Let's start out with the tax deferred bucket. Now, these are assets that are taxed, where taxes are postponed until withdrawal. These accounts do grow without being taxed each year. So by growing without being taxed, it allows a compounding effect of money. And since you're not taxed, more of your money stays invested and then grows. And these are usually contributed with pre-tax dollars, which also reduces your taxable income. A lot of these you're aware of, 401ks. Some of you might have these with your employer. A lot of times employers will match up to a certain amount. So anytime an employer matches, it's free money, for the lack of a better term. Also individual retirement accounts, and then certain annuities. So with the tax deferred bucket, we get upfront cost savings, compounding growth because there's no annual tax drag on the money. And also potentially, if you're contributing with pre-tax dollars, it could help your tax bracket as well. Now, some of the potential disadvantages of the tax deferred bucket is withdrawals are taxed as ordinary income. Taxes are delayed, they're not eliminated, and there's also potentially penalties if you do withdraw from this tax deferred bucket before a certain age, like in a 401k plan at age 59 and a half. There's also a lot of uncertainties, future changes in taxes, required minimum distributions start. So now let's look at some of these other uncertainties. The first uncertainty is one we're all very aware of, is the investment risk. And I don't have to tell you how volatile the market has been here recently. You also have the mortality risk. If somebody were to pass away prematurely and they didn't have a strategy or proper planning in place, it could leave a heavy burden upon their family. And then last but not least is legislative risk. Now, here's a graph which shows the top U.S. marginal tax rates back to 1913, when the federal government first instituted the federal taxes. As you can see, when it first got started, it was at this lowest point. The highest point was right after World War II. And over the last number of years, it's been low, but as you know, there's going to be some volatility there. So that's definitely something we want to keep in mind when having conversations with your clients about the tax deferred bucket. Here we have what's called a tax deferred triangle. And on this triangle, we're going to talk about the tax deferred, the taxable, and also the tax advantage. And what I find, and you might find the same thing, is that a lot of people, they're very heavily weighted in the tax deferred part of the triangle, which could have an effect on you when you start, withdrawing money during retirement. And a good question to ask your client is, would you rather pay more or less taxes in retirement? And I'd venture to say pretty much everybody is going to say they want to pay less in taxes. The income effects, let's say somebody has a 401k plan and they do retire, so they start taking income out. Some of the effects are obviously your taxable income increases. When your taxable income increases, you're paying more taxes. It also will have an effect on your Social Security benefits because you're making more money and your benefits are reduced because of the additional taxation. And also, since Medicare premiums are tied to taxable income, it could increase the amount of money you're paying for your medical benefits with Medicare. Now let's look at the taxable bucket, which was on the left-hand side of the triangle we were looking at. And, many of you are aware of these brokerage accounts, banking accounts, money market funds, and other non-qualified accounts. Now, this is the most accessible of the buckets. It provides a lot of flexibility, which is good. And this seems to be ideal for more of the short-term needs and liquidity, and also for any type of emergencies or maybe large purchases that are needed. Now, with the taxable bucket, unlike the tax-deferred bucket, taxes are paid annually. And since taxes are paid annually, there is a tax drag on your money. Selling an investment would create a taxable event, whether it's a short-term gain or a long-term gain. And the compounding of your money, because you're paying taxes on an annual basis, is lowered. There are no upfront tax benefits since you're paying with after-tax money. And there's also subject to market volatility. You could experience poor timing in your investments. In other words, you might buy high and sell low, which is never a very good combination. Some of the advantages of you contribute with after-tax dollars, and now we're going to the tax advantage bucket. I'm sorry. So in the tax advantage bucket, you contribute with after-tax dollars, and these accounts are structured to help you decrease your taxes, grow your wealth, and also protect your assets. Contribute with after-tax dollars. The growth can be tax-free. And a lot of times you think of municipal bonds in these situations, maybe a Roth IRA, and also permanent or cash value life insurance. So these would grow tax-deferred or tax-free, which potentially reduces your tax burning. And you will have the earnings without the tax drag because they are tax advantaged. With the tax advantage buckets, you don't get a deduction today because you are paying with after-tax dollars. Not everyone qualifies based on certain higher income limits. And if you do take out money early, there could be some tax consequences if the plan is not structured properly. Now let's circle back to the tax triangle. We talked about the tax deferred accounts, and we talked about taxable accounts, and now we're talking about the tax advantage accounts, which we know could be Roth IRAs, right? We do have the contribution limits there. It could be municipal bonds, but those returns tend to be a little bit low. 539 plans are really designed for college funding, not really designed for retirement. And here we have cash value life insurance. Since many people are heavily diversified in the tax deferred bucket, it's really tough for us to predict the future because tax rates, there are some uncertainty in regards to tax rates. And conversation with your client is maybe about reallocating some of those funds that you have in the tax deferred bucket into this tax advantage bucket. And that's with cash value life insurance. A common goal of many people is to accumulate supplemental retirement income. Potential solution for that is a properly designed permanent life insurance policy that can have cash value grow, tax deferred. Distributions, if set up correctly, can be income tax free. And also the death benefits would be paid on an income tax free basis. Another way to look at this is the heavily weighted versus the balanced approach. So let's look at somebody that's going to be taking out $100,000 a year. And if they take out that $100,000 from a qualified account, what's going to happen is they're going to take it out, but they're going to be taxed at 24%. So as opposed to getting out $100,000 because they're taxed, they're going to be having $76,000. Now, if we have a more balanced approach, which we're going to have the three buckets, we're going to have tax deferred, taxable, and tax advantage. We're still going to take out that same 100,000, but we're going to take out 40,000 from the tax deferred. And since we're taking out only 40,000, not 100,000, the tax burden's going to be a little bit less, right? So you're taxed at 22% as to 24%, so you're getting more of your money. We're going to take out 30,000 from that taxable bucket. And assuming that you're going to have a capital gains tax of 15%, you're taking home $25,000. And then last but not least, taking out 30,000 from a tax advantage account. And it's not reduced by taxes because it could potentially be tax free. So as opposed to taking out everything and being heavily weighted in the qualified and account, the tax deferred account, you're bringing home $76,000. But having a more balanced approach, you can see we're taking home quite a bit more money. And that's where planning becomes involved with you and your clients, kind of finding out what their goals are, what their needs are, and having that conversation with them. Get this question asked all the time, then why isn't life insurance considered more often during retirement planning? Common objection, I can get a better return in a mutual fund or stock portfolio. But a lot of times clients are unaware of the potential tax cost, with those investments. And like I said, all that kind of goes back to proper planning with your clients. In closing, I want to, because I know we're kind of running short on time. In closing, I want to talk about, how permanent life insurance can supplement those three buckets and help you diversify across those three buckets. Permanent life insurance policy can play a key role across all three buckets. It offers tax deferred cash value growth. It also offers tax advantage access through policy loans if the policy is structured properly. It reduces reliance upon taxable income. And unlike other accounts, there's no contribution limits based upon income, and there's no required minimum distributions, which you would have in a 401k plan. And then last but not least, you would receive a tax-free death benefit. Now, in closing, hopefully these 20 minutes have proved to be beneficial to you. Hopefully you've learned a new sales idea, a new concept, and hopefully it's going to make you a little bit easier for you to have those conversations, with your clients about the need for life insurance as part of your overall financial plan. And if you're not having that conversation, like I said, hopefully you start doing that, moving forward. I want to thank you very much for your time today. Please feel free to reach out to me and think of me or us as your back office when you do have needs with your clients, whether it's life insurance, annuities, long-term care, or disability insurance. We're here to support you. We can help you, information to obtain, to design a proper plan. We can jump on a phone call or a Zoom meeting with your client to help present. We can walk you through the application process all the way through underwriting and hopefully to a policy delivery and getting commissions paid. Once again, thank you very much for your time today. Are there any questions? Any questions? I do not see anything in the chat box, but I think it ran a little bit long, but I really appreciate your time. Hopefully have the opportunity to work with you. Here's my contact information. Please feel free to reach out. And once again, thank you and have a great day.